Hello, builders. My name is G. Today, we're going to be talking about something a little bit different. Usually, I talk about startups and tech and a lot of those types of things. Today, we're going to be talking about the financial markets. Funnily enough, because building a new app in the financial space means that I should probably be doing more content in that space, but also getting more educated in the space. And so, obviously, getting a Robinhood notification in the middle of the night, Fidelity notification in the middle of the night, that suddenly things are dropping and tanking. Should probably investigate that and figure that out. So I'm going to throw a little tweet up on the screen now and take a look. So a lot of the current market volatility right now, and look, by the time I'm recording, honestly, most stocks have recovered. But, in the early mornings, you were like, what's going on? Well, it looked like a lot of it was caused from, or at least the catalyst, right? Never know what the net cause of some of these market movements are, but a catalyst which may have triggered a lot of the frenzying selling that we saw stemmed from the Japanese stock market. And the decision by the Bank of Japan, essentially the Japanese version of the Federal Reserve, hiking interest rates. They moved it up by 25 basis points. Basis points means a percentage of a percentage, right? So 0.0025, or whatever the number is. 25 basis points. Don't do math while recording. And so why does that matter, right? 25 basis points, percentage, 25 percentages of a percentage. Well, why does that matter? Well, there are people in the financial markets, they make their money off of finding sources of arbitrage and of uneven balance in the markets. So one of the things that they discovered was that because of the current inflationary cycle that's going on and, the different exchange rates between the Japanese yen and the US dollar, they decided, and because Japanese interest rates were basically at zero, and just like what this tweet is saying, right? Many investors were borrowing Japanese yen at low interest rates, converting them to US dollars, and then using this to buy US stocks, right? So basically there's a kind of float play there that you can, because the interest rates are high in the US, you find a lower interest rate somewhere else, and then use that to then use US dollars to buy US stocks. There's a play that can be made there, right, and some money beyond just the normal gains and losses, which in the cutthroat hedge fund markets and all that type of stuff, algorithmic trading, that stuff adds up over time, right, and especially with large dollar amounts. Now, because the interest rates have now hiked, right, the yen, one of the factors of interest rate hikes, right, is that it strengthens a currency. It's just one of the net results from that. It's not directly, the result, but generally those things are correlated. You increase interest rates to tackle inflation. And so, the Japanese yen here, as it says in the tweet, strengthened significantly against the US dollar. Now these traders are in some deep doo-doo. Not only must they pay higher interest rates for the yen that they've borrowed, Forex, which is foreign exchange, right? Because if the Japanese dollar is now stronger against the US dollar, well, that means that they technically owe more, right? Because however much they borrowed, that yen now is stronger against the US dollar, which means that there's more USD that's needed to convert into yen to pay it back, right? And so also, it's there that in some cases, the US assets that they purchased, when you buy and sell them, may not be enough to cover that foreign exchange change. So honestly, this is just like a moment in time trade that could have happened, right? And according to this, right, and the extent of bloodshed, if you will, in the Japanese stock market and the U.S. stock market, shows that a lot of people were highly leveraged, right? They were borrowing a lot against, they were borrowing a lot of yen and, these types of really, movement in the interest rate and in the exchange rate causes massive losses. And, it says here, right, this causes a huge unwinding of these trade positions, right? When the banks start seeing that, they get nervous, right? Especially when the numbers no longer make sense, when the worth of the U.S. assets that were bought by this firm based off of the, amount of yen that they borrowed, that usually triggers something called a margin call, right? And when people are leveraging their borrowing in investment parlance, it's generally considered margin. And so, obviously, big losses across the board from those types of people. They've got to unwind it. They've got to sell U.S. stocks to cover their debts. And honestly, in some cases, right, they dip. They might have to borrow money to pay back some other loans, or they got to cash everything out. Right, and so obviously that caused a major sell-off in the Japanese stock market, which then also, partly in the U.S. stock market, because based off of reading between the lines here, right, if you run out of U.S. assets to purchase, you got to dip into your Japanese assets, which, from seeing the losses in the Japanese stock market, it's pretty major. So obviously this is causing pressure on us, but for the most part, I think for most people saw like, hey, there's earnings came in, some good, some bad, right? But for the most part, not anything catastrophic that warrants this type of drop. And so really you've seen a pretty, still some losses, but pretty much have recovered from the 10% down, 15% down you were seeing in some of the tech names. Indices were down, 5-6%, and now they've basically recovered to about 1% to 2% ish, depending on what time you're pegging throughout the day. We'll see at the market close, because I'm recording this at about lunchtime. We'll see how that looks. But obviously he also notes, right, this just adds to more volatility, right? People might be considering unwinding a lot of these trades, so you might be seeing different price movements because of that, right? Some people are going to take risk on, risk off, lock in some good interest rates now before the predicted Fed chair, Jay Powell's going to cut rates, in September and November. That's kind of what seems to be the bond market is pricing in. Some people were saying that the bond markets were pricing in also an emergency rate cut. I don't think that's going to happen. This seems kind of more technical than fundamental risks. There are potential signs with the jobs report being a little bit elevated, quite a bit elevated. That there are risks potentially of a recession, especially with, increased unemployment means potential less consumer spending, slowdowns across the board, cascading into, cuts in tech, layoffs, just becomes a vicious cycle. So the Fed, they were on track for a soft landing. Seems to be, maybe they might be a little bit late, right? But again, the way that the Fed chair usually does rate cuts, they look at data, and data is a lagging indicator because it comes out obviously the month or the quarter after the previous, and so there's not really a live assessment of what's going on. You can only react to whatever happens. So generally, a lot of these movements are a lagging indicator. In fact, generally when it's determined that things are, we're in recession, it's generally after the fact. And so, a lot of these news, right, obviously some foreign policy issues, out of my wheelhouse to comment on that type of stuff, but, I think that it's just important to realize, right, for the most part, these movements up and down, algorithmic traders and all that type of stuff, these movements are only going to get more volatile. So, it's ever more important that you do your research. Nothing that I've said today is hopefully construed as investment advice. Do your research, figure out, what are the risk tolerances that you have for yourself. Talk to a financial advisor if you feel like you're under-equipped to be able to do that stuff. But I think that most important thing, I'm going to announce it now, we're going to be doing a show called G Can Invest, where basically I'm going to go through, start learning the process of actually reading a lot more of these balance sheets, whether you're a startup founder or VC, public market investor, should all obviously be getting into a lot of these financial statements and learning more about the accounting that goes behind it, and some of the decision makers, what are their actions, what are they able to do, what are they actually doing, and how does that translate to the most important thing, right? The numbers. And that's a lot of things that, even in the world that I come from, startups, VC, most people don't know their numbers, right? And don't know where the targets lie. If you're talking about wanting to create the next great unicorn, well, we should probably look at the stock market to see, where these companies' earnings looking like when they IPO, when they grow, and when they even stagnate, because often the signs are in the earnings. So announcing that, and hope you enjoy this kind of news update. I feel like I want to do more of these, especially as they come up. Editing is super hard for me just because it takes a bit of time, and to get all that stuff settled. And so hopefully I can try to turn things out kind of like today, somewhat of an emergency pod, although the emergency, nothing too serious. So hope you enjoyed. Please follow, like, subscribe, however, on whatever platform you're watching on. And until next time, keep on building. Thanks for watching.